thank you for joining us again. This is Robert Schein, Managing Director, Partner at Blanke, Schein Wealth Management. Today is a part 2 edition of yesterday's Market Insights and Observations. And I encourage you, if you haven't checked in on part 1, the part 2 will make a lot better sense if you happen to do so. And if you actually saw it yesterday, I encourage you to rewatch it. And then let's play this right through as I continue the conversation. In my travels the last few weeks to several conferences, investment conferences, with all the big portfolio managers and hedge fund managers, private equity, so on and so forth, essentially the Wall Street heavyweights and how we're allocating capital, sharing ideas, and gaining insight in terms of how we move through the market with all this uncertainty, with all this volatility, with the potential of a recession ahead. Now, one of the main sort of checkpoints that we're looking at with regards to the U.S. economy and as it relates to, is there a recession right now, or are we moving into a potential recession for 2023? We do believe that we will see one. And it really comes down to, and I'll put this on the screen right now, basically it's from Strategis. It's an investment firm that we follow their research. And this is their dashboard that describes the U.S. recession checklist. And yes, we still should be worried because we're not quite there yet. And you see all the red check marks and all the different indicating categories, and obviously the movement and the explanation. But let me just recap the categories and tell you the one that's standing out right now. The recap the categories is like a single, using housing permits. That's a front end indicator of the U.S. economy. And those are on the decline. Non-defense capital goods for aircraft orders, that's on the decline. The University of Michigan consumer expenditures, that's a 10-point decline. That's also, you add that to the checklist of potential recession on the dashboard. The ISM, new orders, that's below 50. Anything below 50 is contractionary. The 2-10 spread, so that's the 2-year and the 10-year yield curve. We see that all of right now. You've got the 2-year well above the 10-year, and that always, not always, but historically speaking, that's indicating there's a recession on the horizon at some point in time. It just doesn't tell you when. It just says there is a recession on the horizon. So that's been inverted all this year. BAA spreads, that's in the fixed income market. And so as those increase, that shows pressure in the bond market, sort of elevated concerns, and those have risen notably. So that's, you can check that box. As well as financial conditions are tightening. You could see sort of globally, a lot of the financial conditions are tightening. So the one thing that we have yet to see, and if we check it, that would be 8 out of 8 on the recessionary indication based upon Strategis' checklist, which is the weekly initial jobless claims. The 4-week trend needs to be rising. And right now, claims have been choppy in the past month, but probably haven't seen enough weakness to remove the threat of wage spiral developing, meaning the labor market's just still way too tough and tight. And so that's what the Federal Reserve is trying to do, raise interest rates, as I said yesterday, to impact corporate earnings so that corporations start laying off, or at least not offering those job openings. That's essentially the playbook. That's exactly what they're trying to do. But the Fed's going to be remaining on high alert as it relates to this one key economic indicator in the U.S. economy. That's a lag effect, though. There's a lot of seasonal concerns. There's a lot of sort of weather concerns. So that's going to be choppy for quite some time. That's going to put the Fed on alert for quite some time. We expect 75 basis points in November, as well as 50 basis points, maybe higher in December. It remains to be seen. We don't want to sit here and debate that because I think the TV does more than that for all of us. That being said, inflation is here. We know Fed is going to be raising interest rates. We know that. But what happens in the future, Rob? This is all wonderful information, but how do we position? How do we protect? How do we take advantage of the opportunities? So I'm going to show you this next chart. This next chart shows what our thinking is right now. This chart shows that the market still expects the Fed to pivot as they have historically done. Now look at this. This is the Fed funds rate, year-over-year change. It's what the Federal Reserve is ultimately using is, hey, listen, we're going to raise interest rates. And if you see on the far right of your screen, this is where we are with current interest rate policy. Previously, all the way through, historically speaking, you see those blue dots. That means that the Federal Reserve has taken interest rates policy and raising the interest rate far too high at some point in time. And you could see that earlier this year, or earlier in the decade. You could see that back in 2006 and 2005, and all the way through 2000, so on and so forth. So ultimately what this indicates is we don't know how high the Federal Reserve Fed funds rate target or even rate actually goes. But we do know that we're closer to getting to that than at the very beginning of this year. Keep in mind, we'll be up to 450 basis points increase from the start of this year to potentially at the end where they start the 2023 new year. And when the Fed pauses or even pivots, we will see the indication from the labor market as it weakens versus tightening. If there's any slack in the labor market, that will give the ability for the Federal Reserve to take a breather and see where they are. That might have a lighter impact on corporate earnings. That potentially could be better set up for 2023 for earnings versus a worse setup. The equity markets in 2022 are discounting a worst case scenario. Again, we're expecting $240 in the S&P 500 start of this year as earnings, and that's come down substantially. We're down to some estimates on some Wall Street down to $200 a share on a 15 times multiple. Takes your S&P 500 to 3,000. Well, we're pushing back to 4,000 right now, so that's not welcome news. But no one really knows. The market doesn't know. The Federal Reserve certainly doesn't know. They have a history of being wrong majority of the time. And ultimately, unfortunately, we have to work our way through this. We do know that the economy is slowing. We do know, if you look around, including the real estate market, which is 40% of the CPI, which is a lagging indicator. That's what I brought up last week, which is Jeremy Siegel is pointing to, hey, by the way, once we get forward, we move the window forward for the economic reporting, all of that data is lagging. Once we move month over month, year over year, you're going to start to see inflation come down. And that's really what we're going to have to be patient and wait for. Rob, that's wonderful. Thanks for the economic lessons and update, and kind of feels like I just got an economics class from you. And I hope you did, because that's sort of the importance of this, and I really appreciate you paying attention. So now what are we doing for our clients? How are we positioning? And again, as I talked about earlier, this is a formula that we follow for many, many decades of Blanke Schein Wealth Management, and we will still continue on this process even in up markets and down markets, especially in down markets. But keep in mind that it's a QCISR. So it's a formula that we've used and we've basically used for many years is, well, number one, quality, whether it's in the equity market, whether it's in the fixed income market. We only have a standard of quality, high quality. That's sort of the pre-screening filter that we use when we're looking through portfolios, inheriting portfolios for clients that have, or prospects that have come into us by way of a referral. We look at the portfolio and say, okay, what's quality, what's not, let's upgrade, let's get rid of what we shouldn't have in the portfolio. Cash is not trash anymore. That's what I said in the part one. I didn't get to it. This is what I mean. Again, at the very beginning of the year, cash was at zero. Banks were paying zero. Money markets were zero, if you will, essentially nothing in terms of getting interest on your money. Right now, we're looking at a T-bill, Treasury bill, with a 4 handle on it. It's about 4% for 30-day paper. And so we're taking advantage of that right now. We're hanging out. As I said last year, this time we raised cash for clients, but we didn't allocate it. We just kept it in cash because the fixed income market went down, right? Some cases by 20%. So we didn't want to allocate the cash and have it go down. We wanted to keep it. Now, cash is looking really interesting in terms of the T-bills or short-term fixed income. Right now, we have a lot of opportunities. If you have money at the banks right now, we're not going to deploy it in the equity market, but we're going to put it in 4% or higher U.S. Treasuries, depending upon the time frame. And that's really, we haven't seen that in a long time. So again, we're excited about that. So cash is not trash anymore. And that's the C. The I is income. Not everything that we invest in, but majority. We look for dividends. We look for fixed income. We look for cash flow. And that's the income. The income sort of builds up in a portfolio, and we can reinvest those dividends. We can reinvest that income, or we can just pay you on your monthly check. And that keeps the income and the monthly check to you. But income is important, and dividends. And a lot of corporations are actually raising their dividend, believe it or not, even in this market with all the uncertainty going forward. That means they're well run, and they see, through just the end of this year into next year. And then SR, this is one of our favorites. Strategic rebalancing. We did this in March and April of 2000 when there was heightened uncertainty. S&P was down 40%. Because we didn't know what the global pandemic ultimate impact was. And we rebalanced clients' portfolios. We took advantage of some things that were way quality on sale at a major discount. And it's worked out very, very, very well for our clients. So there's going to be an opportunity. As I said before, we're pushing back on the S&P. We're going to be 3,900, 3,800. But we could get out of steam. And that could come all the way back to 3,200, 3,100. We don't know. Even 3,000. That's when we jump on that by a strategic rebalance. And again, that will help us moving forward. Again, as I said in the first part one, the long-term trend, the last 50 years, 100 years of the markets have been up. And we have to go through these short-term contractions to get higher highs ultimately on equity markets. So we will strategically rebalance portfolios and take advantage of that when markets look completely dislocated from reality relative to valuation. And then also, Playbook, what are we doing right now between now and year end? This is very important. We're also doing, taking advantage of tax loss harvesting, which ultimately means we're booking losses that we have in portfolios if we have portfolio losses, and then we're going to still rebalance to still stay in the market, but we're at least going to take advantage of, hey, listen, let's be more tax efficient, let's be more mindful. And if you have some tax exposure across the street that we may not know about, real estate transaction, business transaction where you have capital gain, or even a portfolio transaction outside, maybe even trading yourself, let us know either the wins or the losses, right? Do we have cap gain exposure? Because here at Blanke Wealth Management, we'll look at your portfolio here, and then we can offset that to make it more neutral, or even offset to be, no taxes, if you will, if we're able to do that. From a strategic standpoint, and we check with your CPA to make certain that that would be the case as well. Upgrade to quality, I just talked about that. We wait for the market, be patient, and they'll come our way. And then adding to sectors and exposure. This is a perfect opportunity to add to sectors that we want to either add to the portfolio if we didn't have it, or overweight moving forward. We like to overweight. We even like energy again moving forward. So we're going to see more of that in the portfolio. So these are opportunities to be proactive. Our process is to be proactive. And again, it's also based upon the financial planning foundation. So if you have not connected with us recently about, let's say, hey, let's run a financial plan update for 2023. Let's see where we are right now. Let's talk about our cash flows and sort of our wants, needs, goals, values, and everything we're looking to plan for 2023. Now's the time to do it. We encourage you. We're going to be proactively anyway, as we are, to be reaching out our team to you. But if not, give us a call. We're happy to help. So that's part one and part two today. I know I was gave you more than maybe you needed to know, but give us the feedback. Say, hey, Rob, that was good, bad, indifferent, too long, or what else would you like to hear from us? We're here to help, but we're also here to be proactive through markets that are volatile, and we want to get through the other side even stronger than where we are now. We can only do that together. So we're looking forward to hearing from you, and we'll be in touch soon. And thank you for watching, and feel free to share to a friend or family member that may not be on this. Again, it's free. Like and subscribe. Talk to you soon. Take care.